For nearly a decade, central banks have flooded economies with liquidity, keeping rates near zero. However, policy easing is now making way for policy normalization, with the rising rates almost certainly one of the key outcomes in 2018. Despite this change in rates, we remain largely constructive on the asset class. Economic growth globally should be synchronistic with higher momentum in emerging markets. From a bottoms-up perspective, corporate balance sheets have improved in recent quarters, and default should continue to be low by historical standards. From a return perspective, the last 2 years have been very rewarding for emerging market bond investors. However, we're not expecting a trifecta with respect to oversized asset class returns in 2018, largely due to challenging valuations. Our base case forecast is for a 3.75% to 4% return over the next 12 months, broken down into a 5.25% to 5.5% return for high yield and a 2.75% to 3% return for investment grade. Overall, we advocate an overweight in Asia, followed by Latin America, and finally, CEMEA. However, the strategy is a bit nuanced. In investment grade, we would overweight Asia and China in particular. We particularly like the Chinese BBB rated securities and would balance this with an underweight in Malaysia, Thailand, and Singapore. Within investment grade, our least favorite region is CEMEA, where in the Middle East, we do not believe investors receive adequate compensation for the ongoing geopolitical volatility and uncertainty. In high yield, we will continue our long-standing overweight recommendation in Latin America. This trade has worked well for the past 2 years, but we feel has some additional room to run, given higher yields and growth prospects. We continue to favor Argentina, where recent elections provide further positive momentum for policy reforms, as well as Brazil, which has emerged from 2 years of recession on the back of a combination of effective and proactive monetary policies. In CEMEA, we prefer Africa and Turkey, although acknowledging that both could suffer bouts of volatility. While we would recommend an underweight in Asian high yield, we still see selective value in China, particularly in the property sector.